Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. In a recent video, I discussed the global liquidity squeeze and reviewed the charts of the dollar, which has zoomed over the last week or so, but also looked at treasury bonds and gold. And what we've seen, treasury bonds and gold, which are normally beneficiaries of a flight to safety, instead we've seen treasury yields rise very significantly. To me, this is a symptom that people are selling treasuries because they need the cash. It's a symptom of a global liquidity squeeze. Gold has held up okay, but not done as well as I think people would have expected. Normally, one of the indicators I would look at is sentiment in terms of giving a early warning sign of an approaching low. Looking at the call-put ratio, you can see it is lower now than it was in December of 2018. The option premium ratio is above where it was in 2018 as investors are buying put options aggressively, which is boosting their premiums. In an environment like this, however, basically is a panic. Those kind of indicators, I think, are not as useful as they historically have been. Looking at the S&P 500, we can see how it has broken through its 200-day average, various trend lines, prior lows, because in a panic, there is no support. And what we are facing and have been facing, obviously, is an economic dislocation that none of us have ever seen before. So, where is the low in the S&P coming? Could it be at 2200, which is the higher of the two green lines, or just above 2000? Hey, those lines really don't tell us a lot. What we need to see is a number of things. Looking at how the S&P has declined since its high in mid-February, you can see wave 1 down, wave 2 up to 3136 when the Fed executed its first emergency cut, and then an unrelenting decline until today's low at 2280. The only encouraging thing that I can say short term is that the December 2018 low on the S&P was 2347. Closing above that, which the S&P did at 2398, might be an indication that wave 3 ended today. Wave 4, sooner or later, is going to kick in. It will be a significant rally of probably 250 to 350 S&P points, possibly on news that the Congress is passing a safety net program, but it is also likely to be followed by another leg down that will take the S&P below 2280 and lower prices. Couple things that concern me. Stock buybacks have been a tremendous support for the market since the low in 2009. But just like in 2008 and 9, you can see stock buybacks fell off a cliff. The same thing is going to happen, so therefore stock buybacks are not going to be the support that they have historically been. Passive investments have exploded in recent years. And the risk here is that there is a price level at which the S&P can fall to. And when people look at their 401k and they finally can't take it and they decide to sell. So potentially, maybe wave 5 is coming, and that will be coincident with many investors who have gone into passive investors deciding to throw in the towel. So the bottom line is, until we see more clarity in terms of the scope and magnitude of the number of infections that are likely to occur in the U.S. and globally, it's time, and it has been time, to be defensive, which I warned back in my February issues of Macro Tides. Thanks for tuning in. Hope something happens good to you today. More importantly, stay well and stay healthy. Thank you.